Hey everybody, Chuck Barone here. Monday, September 26th, 2022. I can't keep track of my dates these days, man. The time's just blurring by too quick. September 26th, 2022, a very interesting day, very interesting week coming up. So we got a lot of stuff to get over here today, guys. As always, I want to thank everybody for their support for the channel, watching the videos and all the things you guys do, likes and questions and everything you do to help support us. We love you guys. Thank you. Today in the markets, not the great day in the markets today, guys. Stock markets tanking down again today. Down across the board, not healthy numbers. I think the markets now are coming to grips with the reality that times are changing. This recession is going to be a tough one. Inflation is not just going to magically go away. And it's going to affect earnings. It's going to affect a lot of things in this stock market, but earnings being the most important thing. So now the stock market's trying to find a new level where it kind of should be. The bond market today, another horrible day in the bond market. This is an unusual situation for us where we have both stocks and bonds in a bear market. You know, ordinarily, if stocks are tanking, most people rush their money into the bond market and vice versa. This time around, it's really weird because they're both down. The bond market crumbling down today. The 10-year sitting at 3.88%. I mean, that's a pretty. The 10-year's just been chunking up now. Remember how long it was sitting at like between 3.25 and 3.35, just kind of hanging out there? And now it's just boom, 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 half a point higher, no problem. The 2-year really going crazy, sitting at 4.33%. You know, these rates, compared to what we've been dealing with, are shockingly high. Compared to the normal world we inhabited basically from World War II until about 2000 or so, not super high. I mean, it's just kind of, the market obviously is freaking out about it, as you can see by the effects in the stock market. And that, you know, guys, get ready though. This is not like we're getting toward the end game here. This is the beginning, and the Fed's really got their work cut out for them, because now I think everybody can see. You know, we've been months ahead of everybody else out there, right? So we've known what's happening, and we've been talking about this recession for months. The rest of the world's finally catching up to us, coming to grips with it. Hopefully we were in front of everybody, getting our assets in order, getting ourselves positioned a little more defensively, because here comes the retribution for the excesses we've had for the last long time. The dollar today up big, 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 over 114 on the dollar index, just knocking the crap out of every other world currency. This is getting to the point now where this is not a good thing, guys. I mean, I guess if you're planning on going to Europe right now on a vacation, it's going to be great for you, because the exchange rates are amazing. But this strong dollar puts a lot of pressure on everything around the world. It's not going to make our friends happy, that's for sure. It's going to make our enemies even more angry. It helps us a little bit with inflation because commodities being priced in dollars. But when the dollar rises this strong, it hurts all the rest of the world. And I think something's going to have to happen, because we can't let the dollar just keep running crazy. The metals market today, not a good day. Big dollar also means bad day for the metals markets. Down again today. Gold sitting at $1,624 per ounce. Silver at $18.43 per ounce. What a difference a day makes, man. I was seeing silver maybe popping back up through 19 up to $20 just last week. You know, now things have changed. It's just been, I guess it's all pretty predictable, guys, right? The Federal Reserve continuing to raise rates. Higher interest rates strengthen a country's currency. You can see the countries that are lagging, raising their rates, what's happening to their currencies. Japan actually had to buy yen in the market to try to support the yen, because they don't want to be raising their rates. They don't have the same inflation issues we do. So this dollar is going to be a big deal. And again, as always, it's putting pressure on metals. That they're even hanging in there at all at this point is pretty amazing. So hang in there, metals, guys. It's going to be okay. On oil today, not a great day. Oil down, $76.66 for a barrel of West Texas Intermediate. Now, I always got to ask this question, guys. You know, when oil goes from $80 to $82, we see a 20% jump at the gas station, right? Now oil goes from 85 to 76. Where's the prices coming down? They're not coming down here in Nevada, that's for sure. So it's you got to give it to these corporate guys. They know what they're doing, and they're profiting pretty handsomely right now, and they have, because they got cover to do so. Natural gas today was up, but only to $6.92. That's down from about $3, actually a third, because it was around $9.30, I'm guessing. Now it's $6.92, so it's down a couple bucks, $2.50. That's a pretty big move on a commodity. It'll be interesting to see where this goes with winter coming up. I'm sure there's going to be demand for natural gas. I haven't been reading anything about any supply cuts anywhere, so this is interesting to see this price coming down like this. Bitcoin today had an up day, up over 19,000 again, which is nice because it's kind of needed to separate itself from the stock market. It was kind of just going up and down with the market, so it's nice to see a little bit of a change where stocks and bonds down, Bitcoin up. If that was the case all along, Bitcoin would be sitting a little higher than 19K right now, but still gives hope. Now, hopefully this 19,000 is a support line they can keep and maintain. I'd like to see Bitcoin start building up some support at one of these numbers instead of gyrating all around like it's been. But a good day today for Bitcoin. This week, big data week as always, guys, and what we got coming. So tomorrow, Tuesday, we'll get a consumer confidence reports. We'll get a durable goods reports, and we will get new home sales. I think, believe it or not, consumer confidence might not actually go down and might actually even creep up a little bit. But I'm guessing the numbers for durable goods will be down. And I know for sure the numbers for new home sales will be down pretty dramatically. So we got big reports coming up throughout the week. On Wednesday, we'll get the Mortgage Bankers Index. That one, of course, will be more doom and gloom from the housing market. You know, the Fed warned us in Fed speak that there needed to be a correction in housing. I think the numbers we're going to get on Tuesday and Wednesday will support that the correction is well underway. On Thursday, we'll get the GDP report. It'll be interesting to see if we have our third consecutive down quarter or we actually eke out a small gain this quarter. I'm thinking with gas prices coming down, there's a minor chance that the GDP could actually be positive. Whether that can be believed or not, who knows, but it'll be interesting to see that. And also on Thursday, we'll get initial jobless claims. And as you know, we've been reporting ad nauseum on this show, the biggest target the Fed has right now is unemployment. They feel like the job market's too hot. They feel like they need to slow it down to get us out of this wage price spiral we're starting to see more and more of now, and I've been warning about for months. So that'll be an interesting, Thursday's the big day. And then on Friday, we'll finish the week with some other interesting stuff because we'll get the report on personal spending and income. So we'll get an idea on Friday of how consumers are doing on incomes, if their incomes are going up or down, and how are they spending their money. And I'm sure that'll be accompanied with another report about how much debt people are putting on credit cards to keep that spending going. We'll also get the Michigan Consumer Sentiment Report on Friday. So lots of, not the biggest reports, I guess maybe that GDP report coming, but a lot of interesting stuff that'll continue to give us an idea of where we're heading at in this economy and what we can expect to be dealing with going forward. I don't really think it's going to be good news for anybody coming up in the short term, guys. Although I do have a little bit of good news to report on real estate today. Hey, real estate has a glimmer of hope. I was reading a report that rents actually are coming down, and get this, guys, they're coming down by 0.1%. Well, I'm guessing if you're looking at $2,500 a month for your rent payment, that 0.1% is just going to make all the difference. I mean, I don't even know why they would report that and kind of gloss it up like it's in any way good news. This is just like maybe the market reaching saturation where rents can't go up any higher because no one can pay those ridiculous numbers. So I just thought that was humorous, and I would pass that along to you. Also, another interesting report I was reading today we're starting to get more and more calls among the political class for price controls to stabilize prices. I think, and a lot of the reason I'm hearing about this is from more grassroots than our government people, but a lot of people, and I made a report on this a week or two ago about how corporate profits are increasing the inflation. Because corporations are raising their prices when they have no corresponding increase in the costs. They're raising prices more than the increase in their costs because they can, guys, okay? Corporations, we know, have one goal, that's to make profit. If they see an opportunity to increase that profit, they're going to take that opportunity, and nothing's given them more cover to raise their prices or to shrink their packaging and give you less for your money than this inflation is. So now we're looking at the political class and some people that are not complete crazy people talking about maybe we need a limit, put some price controls in on certain things to prevent the corporate world from gouging the crap out of us into oblivion or forever. Because they're not helping these inflation numbers. You know, I get the greed for profit. You know, I want to make money as much as anybody else does in this world. But this is not a great time for it. When you're record profits and record margins while consumers are suffering, not a great look for our corporate overlords, is it, guys? And to wrap things up today, I was reading this analysis that I wanted to share with you guys. I thought it was really well written and really made some sense to me. And what they're talking about in this analysis is that the great policy unraveling has begun. Since the big kablooey in 2008, we've basically had a monetary policy of cheap and easy money. Where interest rates, the Fed intentionally kept rates artificially low to spur the economy. They made money plentifully available, as you can see by the growth on the money supply. And what it did is it created this false impression, okay, that easy money, cheap money, was never going to end. Well, what happens now is first governments start to change that policy, as we're seeing now with the increase in interest rates. So they're not making money as cheap as it was, that's for sure. And with this qualitative tightening, although we'll have to see how much of that they actually do, now they're actually pulling liquidity, pulling money out, which is going to lead to more pain for consumers, right? So governments start the ball rolling. They raise rates and reduce the money supply. And then the banks follow suit because they all have gigantic bloated balance sheets just like the Federal Reserve does. So now they're going to start to correct theirs with the same tactics by raising rates, which they're doing pretty quickly at banks, especially on mortgages. And they're going to do it by making it harder to get loans. They're going to tighten everything. And then, of course, finally, consumers will catch on to this, will borrow less, will save more, if they possibly can, without going under. And it's just going to lead to one hell of a recession here, where it's an epoch. Everything's going to change, and when we come out of this on the other side, the world's going to be a little bit different. Now, the analysis went on to say that confidence and asset prices, so consumer confidence and asset prices from the stock market to real estate, have been artificially buoyed by the perception that there was a magic money tree, quote unquote, and that governments and central banks could support growth with low rates and cheap money forever. The analysis, quote unquote, they cannot and will not, okay? And they went on to say that this has become painfully clear as they keep ratcheting up rates, even against the shrieking of people who think that they're going too far too fast, and money supply starts to tighten. Well, now the banks will go on, like I said, to reduce their balance sheets. So we'll have some bloat there, get rid of that. But what we're going to see out of all of this, guys, is rising corporate bankruptcies and household debt defaults, including on mortgages. They're going to make it more difficult for people who've had access to cheap, easy money to get to that money, including corporations who are not AAA credit worthy. And these corporations, the money spigot's going to get turned off, and we're going to see some bad things happening with debt defaults. Okay. They also then say that these defaults and people not paying their bills will adversely affect corporate and household consumption. People will have less money to spend, obviously. Corporations will not be expanding their businesses, right? Which then will start the downward spiral in employment that the Federal Reserve is looking for. So all of this stuff we've been talking about is starting to happen. The mainstream analysis now is starting to quote the things we've been telling you guys we're going to be seeing. It's real, guys. It's happening before our very eyes. I'm just glad that we were in front of this a little bit and could at least start to prepare for what's coming, what is here, and what's to come. Now, they also went on to say that highly indebted governments will start to suffer debt servicing shock. Because what happened, guys, and some of you may be aware of this, but our government, instead of financing when rates were dirt cheap and financing for long term, 30-year, selling 30-year treasuries, which was typically the way the government did it, they wanted to shave off even a little bit more in the interest rates. So they started selling way more 2-year, 5 years. Then they started selling. 30 years are pretty much out the window for a while. I guess they're making a comeback now. And so these short-term bonds, as they roll over and they become to maturity, now they need to replace it with a new one. These new ones are not going to be at 2%. They're going to be at 4%. Right? What is the 2-year today? 4.33. It's going to be painful for these governments, not just the U.S. government, but all around the world. All of these governments are going to start getting price debt recovery, debt servicing shock, and that's going to cause them then to start reacting in ways that may not be great for us either, because they're going to start cutting spending, and they usually go for the social stuff first, not the military, right? Now the government, and the bad news is, in this recession we're going to be at, and the times we're in right now, the government doesn't have the ability to raise taxes or to really raise revenue much because of the way the economy and consumers are going to be. So this really handcuffs them in servicing debt that we could be paying as much as twice as much in interest on the debt. So this is all bad, bad stuff. But the conclusion is that all the excesses of the past decade, consumer spending, asset prices, government debt, everything basically has been in excess. We can kind of agree on that. When houses are going up $100,000 in a year, I would call that excess, right? Anyway, this excess is coming to a close. We're on the start. The snowball that I've talked about from the beginning is now really picking up momentum down the hill. It's getting bigger and bigger. I just feel bad for the town at the bottom of that hill, because when that snowball smashes through that town, it's going to obliterate everything, guys. I'm starting to feel a little more negative about what could happen here. This analysis was interesting to me because it made me really understand how powerless the government's going to be to help. I've been saying there's no help coming, but this kind of cemented it. So I hope you'll be listening to what we've been saying, guys. Hunker down, man. Play it very conservative right now. Survival's the name of the game. And if you can do the simple things we've been recommending, you'll be glad you did. We'll come out of this the other side. We'll look at a brave new world, and we'll see where we go from there. Anyway, guys, that's it for today. I really appreciate your support as always. If you like what you're hearing, hit like. Ask me your questions in the comments section. Don't forget, askchuckbarone@gmail.com for your more complex sections, or more complex questions, forgive me. Tomorrow we'll be going over some data coming in, and the rest of this week, look forward to talking to you guys. Let's get some guidance. Get ready, guys. Until we talk tomorrow, take care. Thanks.